Hey, welcome everybody. Welcome back to our podcast, our video cast. What do you call these things, Tony? Now that we're people can see us. Maybe they don't want to see us, but
Do we have faces for radio?
yeah, maybe we should just do the radio clip. So this is Road to Retirement, Brookside Tax. I'm Chris Anselmo, the president. We also have Tony, also known as AJ.
That Tony, yeah.
Yeah, that's Tony. So he's
He's
a
up
financial advisor with us. And our co-host, Mr. Radio himself, Tony Shore.
I don't know about that, but yeah, we've got two Tonys today. This could get confusing, but you know what? You can never have too many Tonys. That's what I always say.
My middle name's Anthony, so that's but
yeah,
Mr.
we're all
Shore there,
Anthonys.
he's got that radio voice. If you ever call up Gradient, he's the voice of Gradient. So
Hey, it's going to be a hot one today. 85 in town, 95 in the valley. I suggest y'all play on the old jalopy and head on out to that beach.
yeah, well, it's only 10 here, I think, if that.
Yeah. I think it's below zero where I'm at. I'm in Minnesota right now, and it's below zero. So
wow.
got that going for me, which is nice.
Yeah.
So we thought this being the first broadcast of the year, that we would probably have like a little outlook for 2022, and maybe a little bit of recap of 2021 where we were. And Tony's really Tony Marlette has his ear to the economy daily, so that's why we invited him for the show. So Tony, what do you think of your how did 2021 end up?
I mean, 2021, under all the circumstances, Chris, was pretty spectacular. Towards the end of the year, we thought, from a market perspective, and really from an economic perspective too, this was going to and it did challenge some of our stronger years that we had in 2013 and 2019 as well. So markets finished over 27% for the year altogether. Business valuations remained high, but somewhat strong. And long term, markets are going to continue to follow those fundamentals. So with everything that was going on with COVID/Omicron, inflation concerns, we had some foreign policy concerns, all those things in 2021. Really, the business valuations and fundamentals were kind of the trump card.
If we could just get those docks unloaded, what do you think, Tony?
Yes, the supply chain issues have been a huge problem.
Yeah. We were on California not too long ago, Mr. Shore and I, and I talked to some people out there in California about the docks, and they said it's really it's not a labor supply problem. It's a problem with their tax laws, and they changed their tax laws, so they want everybody on W-2s, and a lot of the independent truckers aren't on W-2s, so they can't come in and grab loads. So it's kind of a mess, and hopefully somebody in California wise enough will step in and maybe have a 60-day freeze on that policy to get those ships unloaded. But so Tony, what do you think? What have you heard? You talked to a lot of other advisors. What are they saying about the last year?
Oh, yeah. Well, if you're asking me, I do talk to a lot of different financial advisors, and you and I were at that financial conference in California, as you mentioned, and some of the top advisors from across the country got together. And of course, it was a lot of fun. It was in California. There was some great weather, but they all, said, they predicted, I think, or thought there would be a correction with the markets, as we've seen here in January, at least, and you guys know more about that than I do. But yeah, they all talk about the economy and things like that. But of course, if you have a plan in place and it's a well-structured plan, you don't need to worry about market fluctuations as much, right?
Right, and I think one thing to take away from this is that we're on top of this, and our money managers are on top of it. They're looking at it every day, so I wouldn't be in a panic that look, markets have to go up or down, or they wouldn't be markets. I mean, if it always went up, right? And I always think, like, for our listeners, you need us more when the market's volatile or when it's going down than you need when it's going, like, when the roller coaster's going up. You don't need anybody. It's the panic on the way down where you need somebody to hold your hand.
Yeah.
So
yeah.
And I think they still a little skittish on bonds right now because of interest rates and inflation. So, portfolio wise, what are we looking at, Tony Jr.?
Well,
AJ,
as far as you mentioned before about not needing us as much when the markets are up, you're absolutely right. When you diversify, when you have assets managed, really that's a way of reducing your risk right there. So in times of volatility, that's definitely going to help out. As far as bonds go, reading some of the economic reports and things from Gradient to start the year, they really don't seem to think, and I have to agree, that bonds are going to be anywhere above positive in 2022. We could even be looking at negative returns with interest rates going up. And just yesterday, we heard the Fed come out and say they're expecting to raise rates as soon as March. Now, whether we have 3 rate hikes this year, I've heard some people say 4. They're going to go up slowly, but that's, to address what is now the number one economic concern, which is no longer COVID, it's inflation.
Yeah, and inflation's been pretty low over the last decade, but now it's sneaking up there. So if inflation's 5 or 6%, and your bank products and your bonds are only paying you 1%,
right?
You got an issue, right? So we look for alternatives that but people still want safety, so we do have to concern ourselves with safety. So we do use some alternatives there, either alternative investments like buffered products we talked about on other shows, or maybe even index annuities or index life insurance. So.
Right. And you're still able to participate with those things. You just don't have as much risk on the downside.
Yeah. Taxes. I don't know, it's tax season soon. I took my little golf trip a week or so ago to get out before tax season, but tax season's right around the corner. I think actually the IRS just opened up the e-filing thing yesterday or the day before. So we're now able to do tax returns, but we normally don't tell people to get them in until February, because often what happens is people come in early and they do their tax return, and a week later they get another 1099 in the mail, right? So hold off if you can.
The real question is, do you golf worse when tax season is weighing on your mind?
Yeah.
I'll tell you what, I have for probably the last 20 years almost, I have a golf trip planned on April 16th. So
the day after.
Yeah, so or 17 maybe. So all tax season, that's like my focus. Like get through tax season so I can get on my golf trip. So because it's nice to get away when the weather's breaking. And personally, I don't mind it being winter during tax season because we can't enjoy the weather anyhow. So hell with everybody. And right around April 1st, I start hating people. So just kidding. But what else do you see? Anything you're telling clients right now where to position that safe money?
Yeah, I mean, you brought up a good point. We've talked about bonds. A lot of people will go to gold and precious metals when things appear volatile, but rising interest rates don't help those things either. So,
and I always tell people it's hard to liquidate them sometime. What are you going to walk into your 7-Eleven and hand them a gold coin for your cup of coffee?
Well, they'd love that.
I mean, how are you going to get you're going to get change in gold? I mean, it's hard to find change right now anyhow. But
yeah. I mean, the good part about investing in it through a portfolio is, you can invest in those solutions without actually having to maintain, obviously, the physical.
Right.
So there's metal or anything like that.
For the listener, there's 2 ways, right? You can buy a product, or you can actually buy the physical gold or physical. Right. The physical one's tough because you have to house it somewhere, and how do you when you take it physically, you have to take it somewhere. What has Gradient said on the outlook so far for next year? Have you heard anything from Gradient?
Yeah, I mean, as far as we should be expecting some volatility in 22, above and beyond, we've talked about a few things. We've addressed a lot of things that are included in this volatility. It's also a midterm election year. And while this isn't a political podcast, it's certainly going to weigh in on what the markets are going to be doing. There's a lot of uncertainty when you throw in that into there as well. So there's going to be volatility. I don't expect bonds to come to the rescue. I don't think precious metals are going to do the trick. I think this is just a great opportunity to make sure that your investments are aligned with your overall time frame and your goals. We don't ever want to make investment decisions, especially over the long term, based on short-term events.
And I think our overall policy is invest in quality, right? By the Googles, by the Amazons, by the IBMs of the world, the McDonald's and the Disneys and things like that. And, God forbid if all those were going under, there's a lot of worse stuff going on, right? So.
Oh, that's right. You and I were talking earlier before the podcast about having everything, say, just in one stock. That kind of lends itself to the diversification theory. If you have one stock, like say UPS is a good company, they're a strong company, but it's still just one stock. Whereas if you have a whole portfolio allocated to many different companies, the chances of that whole portfolio, going down in flames is extremely unlikely. And if it does, like you said, we have bigger problems.
Yeah. And Mr. Shore, you might have seen it with other people. Like we'll have several clients who, it's probably not the right to say, fell in love with a stock, or maybe they worked at a company and they got a lot of stock, and they retired and they love their XYZ stock.
Yep.
And it's a great stock. It's a great company, like even Tony mentioned, maybe UPS, but you're risking your whole portfolio on one stock. I mean, there's how many stocks out there? 10,000 stocks out there or so. So we'd rather see you diversify a little more.
Sure.
Some of the issues possibly is you might take a tax hit if you have to do that, but maybe not if it's in your retirement plan. So if that stock's in your retirement plan, that would be a good way to diversify without having to pay the taxes. Get diversified before you take it out of those tax deferred positions. So
yeah, that makes sense. And I see that happening a lot. And what's funny about what you just mentioned is I see it being regional. In other words, in a certain area, there's one big company.
Right.
Like where I'm from in Minnesota, we've got 3M, Target, and Anderson Windows. And Anderson Windows, they used to basically, the part of the benefit package was stock in the company. Everybody wanted stock because Anderson Windows just skyrocketed. It's one of the largest window companies in America, and they're very profitable. So all the employees have tons of Anderson stock. Same with 3M. Same with whatever company is in your area. Say in Ohio, if there's a regional company, it seems like the workers, like where half the town works for that company, that's where you see a lot of those. Everybody's loyal to that company in that town. So then I see a lot of people owning like 80% of their portfolio or more is in that one company, which is great to support that company. And in a lot of cases in the long run, it might work out. But boy, if that one company goes, I mean, look at Kodak. Even look at IBM. These companies used to be killer companies. Sears.
We talked about Sears this morning.
Yeah, where's Kodak though? Like in Rochester, New York, so many people in Rochester area of New York had Kodak stock because that's where it was headquartered, their main plants. And then what happened to that stock? I mean, it ended up being worthless, and then now they're gone.
Yeah, we were talking about Sears this morning, and it always boggled my mind. I'm like, how was Sears not the first Home Depot? I mean, they had everything. All they had to do was add wood, right?
Yeah.
I mean, or at least be second to the game and have been, Lowe's or something. But
how was Sears not Amazon?
Yeah, right. I mean, they already had everything. I mean, they had
Sears
in the
online.
60s. They had the catalog that had everything in it, right?
Yeah.
So, but Amazon and Walmart took over, and Walmart's pretty much an Amazon now. You could buy anything you want through Walmart's website, just like you do Amazon.
Yeah.
And we have several companies, big companies around here that people, work, like auto companies, right? We have Ford and Chevy here, and and we had I don't think Chrysler's still in town, or Dodge Chrysler. But like in Columbus, we have Nationwide. So there's a lot of big companies in Ohio. But
Sherwin-Williams,
which is a great stock, and 3M's a great stock. We bought 3M for clients as COVID hit, because 3M provides the paper, the boxes, and the tape for Amazon, right? So anything that has the Amazon effect you want to touch. So, it's the boxes and all that kind of stuff. So, but I think the point is like get diversified while you can. The markets are still pretty strong, and if we have a little bit of pullback, that's actually an opportunity to go buy in, right? So when people have money on the sideline waiting, everyone's always waiting for the market to drop to buy in. But you know those studies, and you've heard them. Both Tonys have heard them about trying to time the market. It doesn't really work. You just gotta be in. I think there's one study that says if you miss the best 10 days over the last 30 years, your portfolio is only worth a third or something like that, or what it could be.
It really is. It's incredible.
Yeah, and I think you just got to be in. But if you don't know what you're doing, this isn't something like you wouldn't do your own surgery if you cut your hand, even though you could. But this is something you should go to a professional for. Hopefully, you'll come to us. But yeah, I wouldn't do this alone. Like I wouldn't work on that hybrid car you have. Tony, yours is a hybrid or purely electric?
Well, yeah, mine's different. It's kind of in between. The Chevy Volt is actually always running off an electric motor, so it's not a hybrid, but it does have a 4-cylinder gas generator in it. So when the battery goes down, the gas generator generates power to the battery. But it's constantly running on the electric motor, which is a little bit different than like a Prius or a hybrid. But you gotta know what you're doing.
Yeah, I just want to put the gas in and step up. So I was in Florida a couple weeks ago on a little golf trip, and we rented a minivan, and it was the hybrid, and I'm trying to start it, and I'm like, I don't know how to start this thing. Like I don't know, and eventually, like a minute later, my buddy next to me goes, why don't you just step on the gas and see what happens? I stepped on the gas and it went, so it was already on. So, but you can't hear the damn thing. So, so, I don't work on my cars. Everyone has their own bailiwicks. And so you really should hire a professional to do this. So, just like you would do with your taxes. This is important money. It's your money. It's no matter how much it is, it's important because it's yours. People often ask, you have what you have, whether the magic number is 1 million, 2 million, 5 million, or 100,000. There's no magic number. You just got to do the best with what you have. So, but we don't want to get too crazy because we do expect that the markets probably are not going to do as well as they did last year.
Yeah, and I mean, one thing people seem to forget, we've been spoiled over the last. Well, we were certainly spoiled in 21. We average historically throughout the market about 3-5% corrections per year. So I expect that, and I think Gradient expects that going forward in 22 as well. And that's the norm. There's nothing wrong with that, or it doesn't mean anything. I mean, we have a lot going on, like we said. Yeah. That's really the normal to be expected.
And people, I bring the roller coaster up thing all the time, but most of the roller coaster, and we have a great park here. I don't know if you ever heard of Cedar Point here, Tony.
Oh yeah,
it's like right. I mean, most roller coasters have more than one hill. Right. So, there's twists and turns, but at the end of the day, you just got to hang in there. But, you don't want to go in there blindly, and you want your safety harness on. And we have ways to do that either through using insurance products to create some safety or maybe some buffered products. So, anything, we're about 20 minutes into this. Anything else either Tony want to say before we wrap it up?
No. Do you want to mention anything about the books if people schedule an appointment?
Yeah. So we have, I don't know, half a dozen books out there in our lobby, and that we've either written or co-produced. And so if you guys come in, you're welcome to take a copy. We have our first one was back 9, I believe. And that's about financial planning. And then we have Rounding Third, which is about estate planning. Being on third base, you're ready. You only got that one leg left. But actually, someone said we should do a book on long-term care planning called The 2-Minute Warning. But but maybe we should do a book like that, because part of our practice for those listeners is we do a lot of. We hired Matt Snyder. He's another attorney that does elder law planning. And Tony, would you believe that statistically 2 out of 3 people over 70 will spend time in a nursing home?
It's crazy. I mean, long-term care is becoming so prevalent. I mean, my mom has already been in and out of it. She was in it for a while as more of a rehab, therapy.
Nobody ever says it's going to be me, right? And it's never going to be me, right? But I mean, 2 out of 3. That's 3 of us on this. 2 of us are going to spend time in a nursing home, and generally it's a 3-year stint, and that's a $300,000 bill. So there's ways to plan around that and plan for it. But so if you need that guidance, give us our office a call. Office number is 440-886-3550. And the website's brooksidetax.com. Look forward to seeing you guys during tax season. It's going to get pretty crazy here. This is Tony's first tax season with us, so hopefully he'll still be here in April and won't quit on us.
Maybe before then, who knows?
Yeah. So I mean, our office gets pretty crazy because we probably have close to, so in 10 weeks, tax season about 10, 11 weeks, 10.5 weeks, we have probably 5,000 people coming out of the office. So, part of it, like, we're going to mask up. We're asking everybody to wear their masks because it's, that's a lot of airflow for, So
sure.
If you don't have masks, we have some come with our logos on it. So don't feel we got all the sanitizers, we got air filtration, we got cleaning people coming in every day. So, we'll look forward to seeing you during tax season. So, anything else, Tony, before we leave?
I think I'm good. I appreciate the opportunity today.
Okay, Tony, you want to take us out?
All right. Well, you know what, guys? Seriously, great show. Loved it. And this has been a really good one. Listeners, thanks for tuning in. That does it for today's episode of The Road to Retirement with our host, Chris Anselmo.